Let me ask you a question. How do you actually know if a property is a good deal? Because I see this all the time. Investors get excited about a property, they like the price, the location seems good, and they just go for it. But here's the thing. Just because a property looks good on paper does not mean it's a smart investment. I'm Jade Hawkins. I work at Palise Property, where we've helped secure over 1,000 commercial properties for our clients. And today, I want to break down a real commercial property deal in Brisbane that recently hit the market for $2 million. I've got the full due diligence report on my laptop here, so I'm going to run you through the financials, the lease details, and the long-term potential. Basically, the exact process you need to do before you buy a property like this. And by the end, you'll have a clear framework to assess any property deal and decide whether it's a good one or not. Let's get into it. The property we're looking at is a 513 square metre industrial unit located in West Eagle Farm, Brisbane. It was listed for $2,052,000 and is tenanted by Seabridge Logistics, a freight forwarding and customs brokerage company. They're paying $96,483 in rent per year, plus GST and outgoings, and the lease runs until May 2026. There's no further option to renew beyond that, which we'll come back to later. At a glance, the property has a few things going for it. The location is part of Brisbane's highly sought after Trade Coast precinct, where industrial stock is tightly held. That typically means low vacancy and consistent demand, especially from logistics-based tenants. The size is also ideal, large enough to attract established businesses, but still manageable from a risk and maintenance perspective. And on paper, a 4.8% net yield for an industrial asset in Brisbane is reasonable, particularly for an area with limited supply and strong infrastructure backing. But of course, what's written on the listing is just the starting point. To really understand whether this is a good deal, you need to break down the numbers and start testing the assumptions. That's exactly what we'll do next. Let's start with the lease. The tenant here is Seabridge Logistics, a long-standing freight forwarding and customs brokerage business with multiple locations around Australia. They've been in the property since 2020 and the current lease runs until May 2026. There's no further option to renew, which is something we flagged earlier. Now, during the due diligence process, we conducted a tenant interview, something we routinely do for commercial deals, and a few things came to light. First, Seabridge have confirmed they're happy with the space for now, but they've also noted that they're outgrowing the office component. When asked if they'd be taking up the option to stay longer, their response was, not likely. That doesn't mean they'll definitely vacate at lease expiry, but it does introduce the potential for tenant turnover in 2 years' time. That kind of insight is important. It doesn't necessarily kill the deal, but it changes how you look at it. If you're someone who needs absolute income certainty for the first 5 years or more, this might not be the right fit. But if you're prepared for a potential leasing campaign or repositioning the asset when the lease ends, it could be a calculated risk with upside. From a lease structure perspective, the tenant is on a net lease, which means they're responsible for 100% of outgoings. That includes council rates, water, body corporate fees, and insurance. There's also a bank guarantee in place for $30,336, which adds another layer of protection. So far, so good. But as always, we look deeper, especially at the building and compliance reports. The strata records showed no major surprises, but there were a few practical maintenance items raised. The complex is due for a washdown, and there's been some discussion around solar panel installation on one of the other lots. These are more operational than structural, but they're still useful to know if you're budgeting for the first 12 to 24 months of ownership. One thing to note, the fire safety documentation wasn't on file. That's fairly standard. These certificates usually stay on site, but it's something the future property manager or your conveyancer should definitely follow up. The asbestos and safety reports were provided with no red flags noted. The building and pest inspection report came back with a few findings, most of which are manageable. There was a small water leak noted as inactive, some drummy tiles in the downstairs bathroom, which the seller has agreed to repair, and areas of rusted roof plumbing, which falls under body corporate responsibility. Again, these aren't deal breakers, but they're the types of things that, if left unchecked, could quietly eat into your yield down the line. And finally, insurance. At the time of the review, no copy of the tenant's insurance certificate was on file, which is not ideal. But again, it's something we routinely follow up through the property manager or the conveyancer. It doesn't suggest anything is wrong, it just means the document hadn't been passed on yet. All things considered, the due diligence surfaced a few normal risk factors, mainly around lease expiry, minor maintenance, and documentation gaps, but nothing that shifts the fundamentals of the deal itself. If anything, it highlights why due diligence is so critical. A property like this can look completely clean in a listing, but unless you run the full process, you'd never know if the lease is short, the tenant's considering leaving, or the fire compliance status is unconfirmed. Now we've built up a layered view of the property, first with the numbers, then with the lease and the tenant profile, and now we're moving into the macro lens. What's happening around the property that could impact its future performance. It's situated in West Eagle Farm, an established industrial precinct that's part of Brisbane's Trade Coast region. The area has always been tightly held, and demand here tends to hold up well, particularly from tenants in logistics, warehousing, and distribution. The property is positioned just 11.9 kilometres from Brisbane CBD, 8.6 kilometres from the airport, and within 20 minutes of the Port of Brisbane. That's a major drawcard for industrial tenants who rely on access to freight and transport corridors. You're also within close reach of major motorways and rail hubs, which further cements its connectivity. This kind of proximity significantly reduces transport costs for businesses, and that's something tenants are increasingly factoring into their leasing decisions. But beyond location, there's also the matter of timing. Brisbane is currently in the midst of a significant infrastructure boom. Several major government-funded projects are already underway or in advanced planning stages, and they're reshaping how people and goods move around the city. Here are a few examples worth noting. Cross River Rail, a $5.4 billion rail project creating a new north-south spine through the CBD, with 10.2 kilometres of new rail line and twin tunnels under the Brisbane River. Brisbane Metro, a high-frequency electric bus network aimed at improving connectivity between key precincts, reducing congestion, and future-proofing transport routes. Queen's Wharf redevelopment, a $3.6 billion integrated resort and entertainment precinct along the Brisbane River, driving foot traffic, tourism, and job creation. Let's not forget the 2032 Olympic Games. While still years away, the preparation is already catalysing investment in roads, venues, and supporting infrastructure across southeast Queensland. All of these initiatives matter, not just for residential or commercial office space, but for industrial properties too. More infrastructure means better connectivity. Better connectivity means stronger business activity. And stronger business activity ultimately flows into higher tenant demand and rental growth. From a supply and demand perspective, West Eagle Farm already has a low vacancy rate and limited stock. There are just 10 comparable industrial properties currently listed for sale in the area, which reinforces that this part of the market is tightly held. And with demand from logistics operators only expected to rise, especially in high access locations like this, the fundamentals are looking strong. So when you combine the micro, a well-leased industrial unit, with the macro, a growing city with billions in infrastructure investment, it reinforces the potential for both stable cash flow and long-term capital growth. So with everything we've covered, the income, the lease, the tenant, the surrounding infrastructure, the question is this a good deal? Let's start with what's working in its favour. First, the location. Industrial property in Brisbane's Trade Coast region is some of the most tightly held in the country, and that isn't changing anytime soon. The proximity to the CBD, airport, and port gives it long-term appeal, especially to logistics and freight operators. And with billions of dollars being poured into the citywide infrastructure, this pocket of Brisbane is only becoming more valuable. Second, the numbers stack up. A 4.8% net yield with the tenant paying all outgoings is fair value in today's market. And when you run it through different funding scenarios, it continues to hold up, particularly if you're financing conservatively. Price per square metre is competitive and the rent isn't inflated, which lowers the risk of future vacancy or resistance at renewal. Third, the tenant. Seabridge Logistics is a known operator with a low-risk credit profile and no signs of distress. They've been in the property since 2020, they're paying on time, and the business model aligns with the location. But there are risks worth acknowledging. The most obvious is lease expiry. With no renewal option in place and the tenant already signalling they may not extend due to space constraints, there's a real possibility of vacancy from mid-2026. That means you'll either need to release the space or reposition the asset in roughly 2 years' time. Now, is that a deal breaker? Not necessarily. Given the strength of the location and ongoing demand for industrial space, it's likely the property will continue to attract tenants. But the timing and cost of securing a new lease, along with any potential downtime, needs to be factored into your planning. There were also some maintenance issues identified in the due diligence, mainly relating to roof plumbing and a few internal repairs. While they weren't major, they're still worth factoring into your cost assumptions, particularly in the first year of ownership. So, where does that leave us? After weighing up the lease terms, the numbers, the tenant profile, and the broader market conditions, this property passed the test. It offered a fair price, a strong location, and a reliable income stream, despite the lease being relatively short. Yes, we acknowledge the risk of the tenant potentially vacating in 2026, but given the tight vacancy rates in the area and the depth of demand for industrial spaces in Eagle Farm, we felt confident in the asset's ability to attract another tenant if needed. That's why, after completing our due diligence, we advised our client to move forward, and they did. The deal made sense, not just on paper, but in context. And for this particular client, it aligned with their strategy and their risk profile. That's what good due diligence does. It gives you confidence to move forward or walk away with clarity. If you're looking at a property and you're unsure whether it holds up beyond the listing, we do offer a standalone due diligence service. We'll go through the same process you've just seen here and give you an honest assessment of whether it's a deal worth pursuing. I hope this video was helpful. If it was, please give us a thumbs up and I'll see you in the next video.